The next topic in Chapter 7 is Subsidiary Ledgers. Subsidiary ledgers are an added step onto the accounting system, so it's nice they come in the chapter where we add special journals and introduce such a great shortcut. Let's review for a moment how our current flow of the accounting cycle is. We've replaced the general journal approach with a 5-journal approach, the special journals: sales journal, cash receipts journal, purchases journal, cash payments journal, and general journal. Transactions are journalized into these monthly or daily, chronological order. The journals are totaled at the end of the month. Each journal, the debits must equal the credits, and just the totals then are posted into the general ledger, saving a tremendous amount of line-by-line posting. Once the general ledger accounts are totaled, an unadjusted trial balance can be prepared to prove the equality of debits equal credits. So in special journals, when you have special journals in your accounting cycle, it has this type of a look to it. We want to build in subledgers now at this point. Subledgers are a place where you keep track of where individual customers who owe you money, and where you keep track of where individual creditors you owe money. Where would this information come from? Well, all credit sales come from the sales journal, and all payments on account from the cash receipts journal. So these two journals provide the information needed for the accounts receivable subledger. You can see where customers purchase things on credit, and you can see where customers made payment. When you purchase on credit, it's recorded in the purchases journal, and when you make payments to creditors or vendors, it's recorded in the cash payments journal. So information for your accounts payable subledger principally comes from these two categories: purchases journal for credit purchases, cash payments journal for the cash paid. And then remember from our first example in our sorting exercise that if there are any credit memos that might affect either the accounts receivable or the accounts payable, these are recorded in the general journal, so the opportunity for affecting both of the above journals out of the general journal is also present. I'd like to bring down two accounts out of our general ledger now and make them a little bigger and look at them. An asset, accounts receivable, I'd like to bring it down out of our general ledger and look at it. And a liability, accounts payable, also brought down from the general ledger so we can look at it. When you have subledgers, you are attempting to keep track of the balance in the accounts receivable account by individual customer and the balance in the accounts payable account by individual vendor. Let's start with looking at what happens in accounts receivable, and assume you have 3 customers: customer A, customer B, and customer C. You have a record of credit sales in the sales journal, and these are entered in total in the accounts receivable journal at the end of the month. During the course of the month, as transactions are happening, they're being entered into the sales journal. And as they're being entered into the sales journal, they'll also be entered into the accounts receivable subledger. Let's assume in your sales journal you have 3 cells listed in chronological order. The first cell that you had listed in your sales journal is to customer A, and it was for $100. The second cell in your sales journal was to customer B for $200, and the third cell was to customer C for $500. And that was all the sales you had for the month. You could expect that your sales journal would total 500 plus 200 plus 100, $500, $700, $800. And at the end of the month, when you posted the total from the sales journal, you would go into accounts receivable and post $800, because at the end of the month you would post the total from the sales journal. During the course of the month, as the sales journal was being completed, you added amounts to the accounts receivable. The rule is, if you post everything in the sales journal as the month progresses into the accounts receivable subledger, that the sum of the individual debits in the subledger will equal the total you post into the general ledger account at the end of the month. And in our case it does. Each day we posted individual activity, and at the end of the month we totaled the subledger and posted its activity. The other journal that affects the accounts receivable subledger is the cash receipts journal. Let's assume that during the cash receipt, the month, we received $700 in cash receipts. Each day, as we recorded them into the cash receipts journal, we would update the subledger. So maybe on the first day, customer C paid us $500, and later in the month, customer B paid us $200, the total of $700. We would post that as the month progresses, keeping track of that in the cash receipts journal, and then at the end of the month, we would post the totals of the accounts receivable. One of those totals would be to go to the accounts receivable account and post a total of $700 payment coming in from the cash receipts journal. Notice now the balance in accounts receivable at the end of the month. 100 debit balance. If you followed the posting rules that the debits in the subledger equal the debit in the control account and the credits in the subledger equal the credit in the control account, then it would hold that the balance in the individual customer accounts would equal the balance in the control account. And you could actually make an accounts receivable list. In our case, we would have customer A showing they owed $100. Customer B doesn't owe anything. Customer C doesn't owe anything. Total owed by person is $100. Total balance in accounts receivable is $100. So the accounts receivable subledger, in summary, holds the individual's activity. Most of the information is brought over from the sales journal, where you pick up credit sales, and the cash receipts journal, where you pick up payments. And those are listed daily in the subledger. We list them daily because we don't want to make credit granting decisions without knowing what the balance in the subledger is during the month. At the end of the month, when the journals are posted to the general ledger and an adjusted trial balance is prepared, you can tell the general ledger is in balance when debits equal credits, and you can tell the accounts receivable control account is in balance when the balance in the subledger account equals the balance in the control account. Let's look at the accounts payable subledger now. that we looked at the accounts receivable subledger in our last example. Most of the entries that come into the accounts payable subledger accounts, and let's have 3 customers, 1, 2, and 3, will come from our credit purchases, where we record purchases on credit, and our cash payments, where we make payments. This is where the information for the accounts payable subledger principally comes. Each day, as you fill out the purchases journal, you would record an entry into the accounts payable subledger. Getting kind of tiny there, sorry. So let's say you had 2 credit purchases during the month. Somewhere in the month you purchased $1,000 on credit from vendor number 1, and you would record that in your purchases journal, and you purchased $5,000 on credit from vendor number 3, and you would record that in your purchases journal. At the end of the month, you would total your purchases journal, and your credit purchases would total $6,000. You would post that into the general ledger in total. And you can again, let's put cash or purchases journal. Again, you can see the posting rule in effect. The sum of the credits in the subledger must equal the total credit in the accounts payable general ledger account. You would pick up the payments you had made on account from your cash payments journal every day as you were making them. Let's say you made 1 payment on account during the month. When you made it, you would come down. We'll say we paid $5,000 to vendor 3, and you would record that payment as it happened during the month. At the end of the month, when you totaled your cash payments journal and you posted it into the general ledger accounts, accounts payable would show that debit of $5,000. Again, you can see the posting rule. The sum of the debits in the control account must equal the sum of the debits in the accounts payable subledger. Let's build in one more transaction. Let's say you had a return in your general journal to vendor number 1. You returned accounts payable to vendor number 1 in the amount of $500, and it was for inventory. So you record the return, and at the end of the month, inventory would be debited for accounts payable would be debited for $500, and inventory would be credited for $500. During the course of the month, you might be posting your accounts payable subledger hit, so you would go into your accounts payable subledger and show a return to vendor number 1. Again, the posting rule's in effect. You now have $5,500 worth of debits in the subledger, and that must equal the sum of the debits in the accounts payable account. There would now be a $500 credit balance in accounts payable, and when you made a list at the end of the month of your accounts payable, you would show vendor number 1 owed $500, vendor number 2 owed nothing, vendor number 3 owed nothing. The total liability should be $500, and that agrees with the accounts payable account. The accounts receivable and accounts payable are called control accounts. And what that means is that there's a subledger that is balancing to them at the end of the month. The way you know your general ledger is in balance is when your debits equal your credits. The way you know when your subledgers are in balance is when the sum of the accounts payable or the accounts receivable balances equal the balances in the control account in the general ledger. In this way, you can keep track of who you owe money by person and by total, and who you owe money to by person and by total. It's only good accounting to know these things, because if you don't know who owes you money, and they think that, they may or may not be willing to pay you. And you always need to know who you need to pay money to so you can stay current on your bills. That is a review of how subsidiary ledgers fit into the accounting cycle. Hopefully that helps.